we do have Tim Ord on the line. You're all waiting for Tim. And I'm going to say, hi, Tim. How are you?
Good. Thanks for having me on again. And
Pleasure.
actually, my website's www.ord-oracle.com. My email is
Great.
tim at ord-oracle.com. So yeah, I want to put that in there. So,
Great. Good.
all right. So we want to take a look at the S&Ps here real quick.
Absolutely. Let's fire away.
All right. There's a gap actually right here between that. Let's see. Today is Thursday, Wednesday, Tuesday, Monday. Monday the market gapped up, and if you go down and test the gap on lighter volume, that gap will be support. If you test that gap on higher volume, if you go back all the way down there, which it did, that gap does not have support. So now today we're basically breaking yesterday's high, and we got about a half hour to go. We're not going to reach yesterday's volume. We're going to be at least 10% lighter than yesterday. So I'm still thinking we're still going to have a pullback here somewhere. I think we're probably going to find support in that 657 range. So it's not a big decline. We don't have a lot of panic here. I thought at one point we might get down to that 650 to 640 range. Right now, I think we're just going to basically test last week's low, which is in this vicinity, which is at 657. So what I'm saying here is the volume studies are not bullish. They're actually bearish. You're testing a gap on higher volume. That's bearish. You're testing a previous high, which is basically yesterday's high, and that's also bearish. So what the market's holding up here for, I don't know. But also look at sentiment indicators. Actually, let's go to trend here, see where the trend is. Over the last couple of years, I've always been talking about the trend readings in 1.2 or higher on the trend close. That shows panic in the market. Panics are bullish. And here we got the bottom window is a 3-day trend, which is actually close enough. We're at coming in 1.17. That's, in my opinion, bullish enough. It's close enough. And that's a 3-day trend. 2-day trend coming in 1.27. That's also bullish, which is this one right here. That's the 3-day, that's the 2-day. The 5-day trend, which is a little more important because it's a longer period of time, is coming in, looks like about 108 or 106. It's kind of neutral. And the 10-day trend, which is basically 2 weeks of panic, because it's 10 days is
Right.
obviously 2 weeks, and it's coming in 101. So you really don't have panic. Panic's actually energy for the market. It's the more panic you have in the market, the more energy it has to rally. And
Essentially, you're saying the greater the fear, the greater the chances of some kind of a reversal.
Right. Yeah, because you only get panic at bottoms.
Right.
You don't get panic, you're not getting the bottom. So the market only panics at bottoms. It never panics. Matter of fact, I've seen market panic in an uptrend. But anyhow, I mark these times with this tan area, the times when the 10-day trend, 5-day trend, which is most important, we're at panic levels, for this period right there, which is basically this low right here. Picked out this low back in April, that April low, because the 10-day trend got right smack at 1.1, the 5 days a little bit over 1.2, and so that's the reason why I marked all that shaded area. And so this blue or this light green area, we're not there. So we need panic to get this rally going, and the market can go sideways and show panic, but the trend can rise. But we're not even getting that here. Matter of fact, if you look at this last period, the market actually was rising back in the September time frame, and the trend was up, suggesting that rise is going to continue, which it did. So anyhow, we don't have the panic in the Dixon trend. The equity put call ratio readings on a 5-day is coming in at 0.55. Anything 0.55 and lower, predict the market will make a high within the next 5 days. So that the equity put call ratio actually is a sentiment indicator, a little bit different than a trend indicator, but it's just not set up for a rally to continue here. If we had big volume breaking yesterday's high today, that would maybe change my mind, but we're not even having that. So it's nothing real big to the downside, but I still expect a pullback. And I still think our big rally's coming. I thought it might start this month, and it's still May because we got another week to go before the end of the month, and maybe we get to pull back next week, or maybe sooner. I don't know, but this rally right now, you have to have a sign of strength breaking a previous high. And today's volume, we're breaking above yesterday's high, is not showing a sign of strength. So we just don't have the energy to keep going. So not a big pullback. But again, I think we get back to last week's low, and that may set up the bullish situation going forward if we get panic in the ticks and trend. We get some, if everybody's leading bullish here, which according to sentiment indicators, they are, because they're buying calls more than they're buying puts. That's just not a good combination. So, anyhow, we can take a look at the gold.
Can I just ask you a question? The high that was made on the 17th of October, just 5 sessions ago, where the trend went to 28.99, that was also because of the fear of the regional banks. That's included in the trend reading that you've got now. And that rising trend, the fact that it's pulled back from 28.99 to 17.30, is it like it has to restart to activate again?
No, say that again. We did have a trend here 2 days ago. We had
the VIX index. The VIX index.
The VIX?
Yeah.
Oh, right here?
Yeah, so it went to 28.99 on the 17th of October. Would that not be like a climactic move for the Dow, or at least for the market? Because usually you get that kind of big spike, and then the market turns around. In fact, the market's been a little toppy together with the VIX index. So I'm just wondering why that didn't work like it would normally do with a very high VIX index.
Right. VIX it's a form of panic. But that was on this day right here. The market actually that did bottom. We kind of fumbled up, but we didn't really have a sign of strength and volume. So I do studies on VIX, but I'm not an expert at it. So
okay. So anyway, you know what you've got next. We're waiting for that. We've got a break coming up. This is Basil Chapman sitting in for Tommy O'Brien. This is the Tom O'Brien Show. I'm speaking with Tim Ord from the Ord Oracle. We'll be right back. Dow's up 188. S&P's up 44. Hi folks, Basil Chapman sitting in for Tommy O'Brien. We're on with Tim Ord, and Tim was suggesting that there was a kind of a mixed message right here. I think that's what you said, Tim, in the S&P, and that you're expecting a kind of a consolidation to continue. Is that correct?
Yeah, I'm looking for a pullback. It should, because the volume studies are not bullish. The trend studies are not bullish. But it's just a minor pullback, possibly to the last week's low. It may get down to the selling climax low of October 10th, which is just a little bit lower, but I'm still expecting a pullback. I'm surprised they haven't started already, but because the volume studies are, but yeah, I'm looking for a pullback anywhere from 650 range to 655 on the SPY. And if we get panic and ticks and trend on the closes, I'll be long in that vicinity. So nothing, not a major top of any consequence, just a pullback and an uptrend.
Good.
So is that all right? We go. So let's go
chart,
look at the gold market. All right, this chart goes back to 2005. It's a bullish percent index for the gold miners index divided by GDX. So it's a ratio. It's a ratio. Bullish percent index measures the point and figure buy signals in the in the stocks in the gold miners index. So it's kind of a point and figure buy signal type thing on the gold miners. In slash, I do it over the GDX. So it's a ratio. Then I put an RSI for this ratio, and for some reason it works really well. All these blue lines are times when the RSI of the bullish percent index for the gold miners index / GDX, RSI got below 25. It seems to have to break below 30. But we just got one. We're actually, right now, this is a 10-period RSI, 2-week RSI. But right now we're at 22.37 on the RSI. So that says the GDX is at least a short-term low here. Over the years, it's pretty rare. You get about one signal every year. Last time we got a signal looks like about January of 2025, this time right here. Market really zoomed up off of that signal. Sometimes it went sideways for a little bit before the rally kicked in, but all the rallies, it pretty much picked out the short-term lows pretty good. And actually, most of the rallies lasted 6 months or longer. I don't think this one is, but at least we're at a short-term low here. And there's another indicator that I use. This is GDX, the daily. When I did this chart earlier today, what happened over the last 4 days was a 3-gap play to the downside. What that is actually is a candlestick charting pattern. And you got a gap. Where's my tool at? All right, you get one gap off the top. You got what you call a midpoint gap. Then yesterday the market gapped up and then came back down and actually tried to close the gap. Actually today we did close the gap. Normally you get 3 gaps in a row, the market will go back to this first gap. And that's where we're probably heading, back to the 84 range on the on GDX. And we kind of had an exhaustion move to the downside. We had a bunch of selling climaxes going back to the beginning of October. A selling climax is when volume basically doubles from the previous trading range or previous days trading. If you notice, this volume right here is about double what it was over the last 5-6 days. Same with this one here. This one's pretty much double over the last several days. This is another one doubled from the previous day. Those usually exhaust moves to the downside. So you get selling climaxes that are actually bullish. And here you got a 3-gap play to the downside. And going back to this chart, you got the RSI of the bullish percent index / GDX, RSI getting below minus 25. So I'm thinking
can I just ask you, does it make a difference if the selling climax is on the bar before the low or as long as it's in that region?
Normally,
GDX, because the highest volume was the day before on the 21st, and then 22nd was a little less.
Right.
But it certainly gapped up.
Right. It basically kind of gets you in the vicinity. Normally, I don't know, 90% of the decline's over. It's what well, these two, a lot of times selling climaxes are tested. These two were not. This one here was not. This one here is hit. Well, actually, I guess this one was tested by yesterday. But normally, you get a selling climax, the next day is usually a low. If not next day, a couple of days later, because the market exhausts itself to the downside. Everybody head for the exit door at the same time.
Right.
So because that kind of dissipates all the selling all at once, especially when the bigger the volume on the selling climax, the more power it has. So if you get a minor one that's just basically double from the previous, double volume compared to the previous days, but if you get a triple or quadruple volume surge, that's actually a stronger
massive
signal. Yeah, that's a stronger signal for a bottom. So we got anyhow, we got a bunch of them. Anyhow, we got a selling climax yesterday. Now we're going to try a rally, and this rally will tell pretty much the strength of what's going on. I think we're actually going to pop sideways in this market, where we're going to have basically a support around 70 on, which is basically yesterday's low, and the previous high up around 84 is going to be resistance. I think we're just going to build a trading range in that kind of a sideways market. We'll see if for some reason volume really picks up on this rally going into this first gap back on last week. I'll change my mind, but the volume needs really to pick up here. But volume kind of lackluster to the upside. Then that previous gap up around 84 is going to be resistance, and we'll probably come back down and just build a trading range, I think. But it's not a top of any consequence. Stocks are still going to perform But it does tell me the ones that had big run-ups to the upside are going to take a rest. And I've been saying that for the last couple of weeks, and I think that rest has started. I'm kind of going down to the second-tier gold stocks, personally, where the monthly charts have turned up, and I'm kind of buying those now. So I think that's what's going to go forward here. We got another chart, kind of looks at the bigger picture. I showed this chart last Tuesday. It's a momentum chart for up-down volume. You get up around 30. We actually hit 32. I don't have the date, but we hit that several, 3-4 weeks ago. And normally that's initiation off of an uptrend. You get that market that strong to hit, because it's pretty rare. Last time it hit it 2016. Time before that was 2019, and finally we just got it in 2025. So that was 6 years ago. The last one we got. The last one, it went up for another 1 year. The one in 2016 went up for another 5 months. Even though we're hitting consolidation here, we may bounce around a little bit, but ultimately we're going to break up and keep going. So this is not a top of any consequence. It's just a sideways move. But 70 to 84, depends how this volume up to the 84 area. If it's really high, I'll keep it. If not, I'll probably sell my long position GDX and try to attempt to buy it back around 70.
Okay, so I appreciate that. I think everyone appreciates what you give us here. Folks, go to Ord-Oracle. He's got the, just one more time, just tell us your email.
Tim at ord-oracle.com.
Fabulous. So we'll have a great weekend, and we will see you on Tuesday.